There we go. All right. Okay. All right, so let's go ahead and start. Now, let's start with depreciation. Now, with depreciation, what we're talking about here is we're talking about a physical thing that wears out, right? Okay? Now, what's important to realize here is the fact that depreciation is a process of cost allocation. And we're concerned about the matching principle. Okay? So, we're worried about the matching principle, okay? So what happens here is you buy a car and it wears out as you're doing business, right? Now the amount that it wears out is an expense, and you want to match that expense to the revenue it produces, because your concern is the income statement, and your concern is that you match the expense to the revenue it produces so net income is reported accurately, right? Okay, so it has nothing to do with market value. Okay? Nothing to do with market value. All right? So, let's get into some ideas of this. So, you have cost, which is what you pay for it. Okay. And so the cost is what you pay for it. And one way of looking at an asset, this type of asset, is that it's a prepaid expense, right? So you buy the car, and then you're going to use it up. So it's, in effect, a prepaid expense, okay? The salvage value. What we're talking about there is where you're talking about your estimate of value at the end of useful life. So you estimate how much you'll be able to sell it for at the end of its useful life. Its useful life is how long you plan to use it. And the depreciable cost, and I'm going to put this under here, is how much depreciation you expect. Okay? So, the cost, of course, is what you pay for it. Everything's based on the cost principle, right? The salvage value is your estimate of how much it'll be worth at the end of its useful life. Its useful life is however long you plan to keep it for, and the depreciable cost is how much value it will lose. Okay? So let me give you an example here. Time flies. It must have been about 10 years ago. Gosh, maybe, well, 10, 15 years ago, something like that. What happened was the used car market was flooded, right? That the new car dealers were offering really good deals, such that it was almost, it would cost you the same to have a new car, a used car, right? And so the used car market was flooded. So what happened was Avis, or any of the car dealers, let's just deal with Avis, what they would do is they would buy a Ford Taurus okay? And they expected, or it did cost them $20,000, okay? They estimated that the salvage value would be $13,000. Therefore, the depreciable cost was $7,000, okay? And they expected to keep it for 2 years, and that was its useful life. Okay, so they did, this is what they paid for it. This is what they anticipated selling it for at the end of its useful life, which is 2 years in the future. So over those 2 years, this is how much value they expected, how much value they expected, how much depreciation expense they expected to incur. When it came time to sell this darn thing, well, of course, they spent $20,000 for it, so the cost was still $20,000. However, the actual salvage value was $8,000. Therefore, the depreciable cost was $12,000, and again, this was after the 2 years. So they rented it out, expecting to have this much depreciation expense, and they actually incurred that amount of expense because the salvage value, the actual salvage value, was different than they anticipated. They had no way of knowing this, right? Okay. Right now, I would guess it's very different because people have been keeping their cars much longer. Right? So I don't think there's a used car market there was. There's all that flood damage, but this is how it all kind of played out. And that was, I don't know, 10 to 15 years ago, something like that. Okay. All right. So, how do you anticipate the depreciation? Well, we're going to calculate depreciation in 3 different ways. We're going to use the straight line method. And the straight line method is based on time. We're going to use the units of production. And that's based on usage. And we're going to have double declining, or we're going to do declining balance. If that's what your textbook calls it, is declining balance. You'll often see it as double declining, but balance. And that's what's called accelerated. Okay? So as an example, buildings often depreciate on a straight line basis. That they lose about the same amount of value every year over 30 years. A car often is units of production. So for instance, if I drive my car on Clark Business, I keep track of the mileage, and they'll reimburse me 48 cents a mile. It's based on usage. That's an example of units of production. And then an accelerated, like double declining. If you buy a brand new computer, and you're taking it back to the office, and it's sitting in your back seat, and you see a billboard, and the billboard has the next model out, right? How much is that computer in your back seat worth? It could be practically nothing. In fact, it could be, you may have to pay to have it disposed of, so it could even be a liability. So double declining is a form of accelerated depreciation where a whole bunch is taken in the first few years. So straight line is a steady decline, same amount every year over 30 years, like a building. Okay? Units of production is by usage. When Clark College pays me 50 cents per mile. And double declining balance is a form of accelerated, like computers were out, because computers were out because of obsolescence. Now, is there a mystery word here? Okay. All right.
It's just kind of hard to see over like people's heads.
Oh, it's people's heads?
Already 7,000, like all that, like his head is like late reading anyway.
Okay, it's Brandon's head?
Yeah,
all
yeah,
right.
it's all his fault.
All right, Brandon?
My bad.
Okay,
No, but it's good, I was wiggling around, I can see it.
all right,
Told.
okay, all right. So is everybody doing good?
Yeah.
Yeah.
I have a general question.
Sure.
We're on the test, where we're gonna ask you to write in the word, is it gonna be, could it be what you wrote on the board sufficient, or should it be what we see in the glossary?
The book is always right.
So the glossary.
And I try to use the same as the book, because like double declining is often what you see here. They use declining balance, we'll call it declining balance. I hope I'm answering your question. In essence, the book is always right, even if you're wrong.
I think what he means is like, how you have declining balance defined as accelerated,
Mhm.
but I'm sure the book has something more than
Exactly.
accelerated. So do we need to know the book's glossary definition?
Use the books. I see what you're asking. Always use the books. Yeah.
Right, Kim? Is that what you meant?
What if it says cost? If we write what you paid for an asset, or should we write?
Well, on a definition, it'll go the opposite. It'll have the definition and you write in the word.
Oh, okay. That
So,
answers my question.
that's the way it works. It will just have the definition that'll be straight out of the glossary, right? And then you write in the word.
So,
Yeah.
okay.
The reason we had to do that is because nobody could get it exact enough.
Yeah, that's what I was worried about.
That's the problem. So the only way to do it is to put in the definition, have the person write in the word. And that's why we did it, and that's what we do. All right. Any other questions, comments? All right. In that case, let's start with straight line. Okay, so we're going to start here with straight line. Now, here's what you do in straight line. Basically what it is, the straight line method is the cost minus the salvage value divided by useful life in periods. And by the way, the other part of that too is, you know, like the book is always right. And I hate to say, and it's practically never wrong. I was always flippant about that, because it really, and that isn't true of every book, okay? But whatever it is, that you always go by the book. And what I try to do in here is I'll try to work, I've done this a number of ways. What I have done in the past is I've tried to add to the book, right? And often what I do is cause confusion. So often I try to work with the book such that I hope you know more than if you just read the book, or if you know, and when you read the book it lands. So you'll know more than just listening to me, you'll know more than just reading the book, so I try to work with the book so it's some sort of a synergistic approach. Okay. All right. Now, so in this particular example, now, by the way, what do we call cost minus salvage value? What's the name for that? Depreciable cost. Yeah. So it's the depreciable cost, which is how much you expect to lose, right? Divided by the useful life. So in this case, what they did is they spent $10,000 for this asset, it's a machine. They expect to sell it for $1,000 at the end of its useful life, and they expect to use it for 5 years. Okay? That means every year it will depreciate $1,800 per year. And again, the straight line, this is the straight line method. And the straight line method is based on the passage of time. Okay? All right? That makes sense? Okay? And so, on December 31st, depreciation is an adjusting entry. So on December 31st, you have depreciation expense. And you're at EXP for expense of $1,800. And you have accumulated depreciation $1,800. Okay? So this shows up as an expense on the income statement, and this shows up as a contra asset. Okay? You guys remember that from 201 when you were putting the balance sheet? And that's the straight line method. And houses and buildings in general, doesn't have to be a house, but buildings are often depreciated on a straight line basis because that's really how they lose value. It's more than passage of time. Okay, every year. And it's kind of the same amount All right, so let's do this. Let me pull down these screens here. Excuse me. Pull down these screens. I'm going to rotate this 90 degrees. Past you here. I'll rotate this 90 degrees and, okay, got the two screens in there. All right. Okay, now, here's some graphs that present the same material. So don't forget, this is the passage of time, it's the same amount every counting period. So what I have here are the slides. And let's go down. Okay. Slideshow and current slide. Okay. So this is what it looks like. So here we have 2010, 2011, 2012, 13, 14, 15. The depreciable cost in this case was calculated at $9,000. Let me see, can I back that up a bit? So in this particular instance, what they did, in this case, okay, depreciable cost is 9,000. So the depreciable cost is 9,000. So 10,000 minus 1, okay, comes out to be the 9,000 as the depreciable cost. So they paid 10,000 for it. They expect to sell it for 1,000. They expect to lose 9,000 over its useful life of 5 years. Okay. The units inspected, that will show up under units of production method. Okay, here's cost minus salvage value by useful life amount per year. Here's that ratio. So what it boils down to now is, here we have the depreciation expense. It's $1,800 every year. Here we have the book value, and the book value goes down by $1,800 a year. So it starts out at $10,000 when you buy it. Goes down by 1,800 the first year, 1,800 the second year, and so forth. And it will always stop at the salvage value. It will never go below the salvage value. Here's what it looks like on the balance sheet. You have the cost minus accumulated depreciation for the book value. Okay. Here's what it looks like in time. So here's the depreciable cost. Okay, that's the cost minus the estimated salvage value. 20% of that depreciable cost happens every year, which is $1,800, and the accumulated depreciation keeps increasing by $1,800 every year. The book value goes down by $1,800 every year. Does that sound pretty good?
Yeah.
All right, let's do this then. Let's do quick study, and let's do some work with this so we can move into long-term memory. Let's do quick study 10.3. You find that on page 421. Here's how it reads. Okay. You know what amazes me, how sophisticated I've gotten with all these gadgets? You know? Can't believe it. Smart classroom and the whole bit. Who'd have thought it? All right, so we have 10.3, so it's right here. Let me go over this with you guys. So what it's saying then, I'll put it up here. I'll hit autofocus, and let me get something to cover part of that. Just kidding. So here's 10.3, okay. So let me read it to you. So on January 2nd, 2011, the crossover band acquires sound equipment for concert performances at a cost of $55,900. The band estimates it will use this equipment for 4 years, during which time it anticipates performing about 120 concerts. It estimates that after 4 years it can sell the equipment for $1,900. During the 2011, the band performed 40 concerts, compute the year 2011 depreciation using the straight line method. Can I turn you loose with that?
Yeah.
All right. And then, I'll put the answer up here. All right, you guys look like ready for some answers. How does this look? Did you get 13,500 per year? So it's the cost minus the salvage value divided by the useful life. So and this is based, and so by straight line method, it's 13,500 depreciation per year. All right? It's based on the passage of time. All right. Questions, comments?
Was that supposed to take us 10 minutes?
I'm sorry, was that?
Was that supposed to take us 10 minutes?
That's what it said.
Good.
Okay. Questions, comments? All right. Let's see how this goes. Let's see. This goes to 320. Is it?
Yeah.
320. Okay, good. Questions, comments? You guys doing good? All right. Jean, you got a comment? Okay. All right. Just look like you have. Let's go ahead. So this was the straight line method, right? Let's go to units of production. Now, as you guys remember, units of production is based on usage. So let's go ahead and put an example up here. Right? Okay, so we're talking about the. Should have done it, right? All right, let me try that again. So it should be this one. Okay. All right. So there should be the units of production. And it's based on usage. Now, in this case, what it is it's the, so step one, what it is, depreciation per unit. And the depreciation per unit equals the cost minus the salvage value. What do we call the cost minus salvage value? Depreciable cost divided by total units of production. So in this case, okay, and then, so in this case, and then step two, now let's go down here, but step two, what we do is we figure depreciation expense. Okay. And depreciation expense equals to depreciation per unit. And of course, that depreciation per unit is one we figured in step one, right? times the number of units produced. So let's start up here with step one. So they paid $10,000 for it. They expect to sell it at the end of its useful life for $1,000, and they expect to make 36,000 units over its useful life. That means that every time they make a unit, it costs them 25 cents. Okay, does that sound about right? Then, in this accounting period, they produce 7,000 units. So, the depreciation per unit is 0.25. Here's where that came from. And they produce 7,000 units. That means that the expense is $1,750. And that's the depreciation expense. And of course, what this is you debit depreciation expense for $1,750 and you credit accumulated depreciation. Okay. You guys are sure quiet. You know that camera's worth a lot, because everybody pictures their private conversations being broadcast on YouTube.
I'm just paying attention, I don't mind.
Okay, well, I just realized that, gosh, these guys are quiet, and I thought, yeah, they're just thinking I'm going to make, okay, you never know, yeah.
How is that shown on the income statement, where it would actually be written off?
This will show up as depreciation expense, and it'll be included among other
So
expenses,
the depreciation expense and accumulated
which
expense.
shows up in the balance sheet.
Okay.
Yeah, Antonio,
What step do you say?
I'm sorry, what?
Does it say depreciation expense equals depreciation per unit times number of units?
Exactly, depreciation per unit times the number of units produced, right? So step one fund was 25 cents per unit, and then 7,000 units produced, so 25 cents times 7,000 units comes out to be 1,750 depreciation expense for the accounting period. All right, any other questions? Listen, let's take a minute here, I'll leave that up, I'll pull this down. Here's what it looks like. Let me pull both those down. You guys are done with that, right? Okay, you're done with that. Let me hit a light here, because it makes it so much easier to read. And then you go ahead and put some. So, in this case, units of production method, step one, depreciation. Depreciation per unit equals cost minus salvage value of total units of production. Depreciation expense equals depreciation per unit, number of units produced. So in this case, the data is the same we dealt with in the last example. The cost is 10,000, salvage value is 1,000, depreciation cost is 9,000. The accounting period is 5 years. That doesn't apply to this problem. That's the straight line. Units inspected is 36,000 shoes. Okay, okay. So, step one, we figured the depreciable cost, and then 7,000 units at 25 cents a unit. The depreciation expense is 1,750. Okay. Now, here's the years. Here's the number of units produced. So 7,000, 8,000, 9,000, 7,500. Here's the cost per unit, that stays the same. However, the depreciation expense varies as the number of units vary. And of course, the accumulated depreciation keeps increasing by the depreciation expense from the previous year, and the book value goes down accordingly, and it always stops at the salvage value. Yeah.
How do they get in the beginning, when you're like, the total units of production? Like how do they come up with this like magical number?
It's an estimate, and it's the best estimate you can make. Manufacturers will supply it, trade groups will supply it. If you've been in business for a while, you have some experience with it, and it is an estimation, and it's going to be off.
Okay.
Because what will happen on this thing is, when you then dispose of it, like when you sell it, the difference between the book value, like suppose they sold this, here's 2013. Suppose they sold it at the end of 2013, the book value is 4,000. And then that's when the reconciling comes. So if they sold it at that point in time, if they sold it for 5,000, there'd be a $1,000 gain in disposal of assets. If they sold it for 3,000, there'd be a $1,000 loss in disposal of assets. And what that does is that then, so if they sell it for 5, it means they declared too much depreciation expense, and that lessened their net income, lessened their expense, their taxes, etc. And then this year, then the $1,000 will come out, the equivalent of revenue. So, and that's where the reconciling takes place. And it's an estimate, it's going to be off. The question is how much. And that's how it's reconciled.
And how would you report the difference?
Well, what it is that if they suppose at the end of 2013 they sold it, right? So in this case, and let's say they sold it for 5, okay? So if they sell it for 5, here's what it'll look like. I'll just go ahead and put it up here. So they sell, so in other words, the accumulated depreciation will be 6, the book value is 4, and it cost them 10. So the way that works is when they sell it, I'll put it down here. So when they sell it, you have the cash, and the cash was this 5,000. You'll have the, it's calling a machinery, I'm not sure what the exact account is, but whatever the account is, machinery, that was 10,000, right? You have accumulated, I'm sorry, you got to reverse those. So what you do, cash will be 5,000, accumulated depreciation.
6,000, or it was 6,000.
Okay, did it disappear? Okay, let's take a look here.
Still there.
Did it 6,000,
Oh,
okay,
I was like,
all right.
confusing.
I'll say the account was machinery, whatever it was 10,000. And then, a convenient way to do it is treat it as a plug figure. Yeah, whatever it takes to make the debits and credits equal.
No, yeah.
So
Which
in
is
this
1,000.
case, when they sold it for 5,
What account would it go into?
oh, gain and disposal of assets.
That's like,
Okay?
okay.
Now, when you sell it, you remove everything from the books. Here's the cash you received. And you could have just figured the gain and disposal of assets, which would be the difference between the cash you received and the book value, and you could have wrote the 1,000 in there as such. Or you could put all these in and treat it as a plug figure. And if the plug figure is a debit, it'll be a loss in disposal of assets. If it's a credit, it'll be a gain in disposal of assets. So you remove everything from the books, reserve the receipt of cash.
Does gain on disposal of assets, like disappear when you're closing all accounts?
It's a temporary account, goes to the income statement, and currently it's an operating revenue. 5 years ago, it used to go down under other. And so what they said is, other, and they said, it's not unusual, you sell machinery all the time, and it's really an operating.
Okay.
Okay. All right. Okay, any other questions, comments? All right, so let's just take a minute. What's the next slide, right? Is that? Now let's get into the double declining. Okay. So the double declining. What happens with the double declining? And I'm going to turn this around.
Steve, can I ask a question on that last one?
Sure.
So you used 6,000 for the accumulated depreciation.
Mm-hmm.
Why did you use 6,000? Because it was sold in 2015.
Well, on the example I put up there, let me just do this. On the example that I put up there, I just said they sold it in 2013.
Okay. I missed
And it
that.
was just, I just made it up. I could have chosen any year. Yeah. Okay, all right. Okay. All right. Now, let's do this. So we're working on the units of production. I set my notes down someplace. Does anybody see them? Oh, there it is. All right. So let's do this. Let's do quick study 10-4. So I'll write it here. So quick study 10-4. And you find that on page 421 also. So here's how it reads. What it says is, refer to the information back in 10.3. Compute the 2011 depreciation using units of production. Okay. Yeah, V?
For the total units of production, would you use the 120 or the 40?
Let's take a look at this.
120.
You use the 120, and then you multiply it, let's see, 120 concerts, 40 concerts. So you divide by the 120 to get the cost per unit, and then you multiply that times 40 to get the expense for that year.
Okay, thank you.
Sure. You guys ready for some answers? All right. Let me turn this on. Let me drop this down. So, the depreciable cost is the cost minus the salvage value divided by its number of units to produce. That means that the depreciation is $450 per contract. That sure seems like a lot, doesn't it? They do 40 concerts, so the depreciation expense for 2011 is $18,000. I'm going to get through your things. No problem. Listen, so, and I'm going to turn this. Well, we'll see. You guys give me feedback as to how helpful this videotaping is. Because it's a pain in the neck, and if you guys think this is really a stupid idea, I'll be glad to quit doing it. Seriously. Okay. See, I think I need this thing just seems to be small now. That line would be right there.
Also by the camera, and you can give me extra credit, and I'll turn it for you every time you need it.
That would be very helpful, thank you. You said you do sure, you want to be the camera person?
And you can give me extra credit.
And what?
And you can give me extra credit.
Well, I sure like to, but that wouldn't be fair. Well, unless we'd have
We
to.
take turns.
Sure, okay. Oh,
We'll share.
with share?
Yeah.
All right. Now, you're doing just fine, but I was going to say, you want to be sure to be careful, and this thing's got to be expensive, so don't break it. All right. Was that a real offer?
For extra credit, yes.
No.
I'm sorry.
Excuse me. All right. All right, you guys okay with that? So the next one then is declining balance. And the declining balance is a form of accelerated depreciation. And accelerated depreciation, most of it occurs right at the beginning. So, in this case, here's how you figure it. So it's double, well, they call it double declining balance here, okay? So it's double declining balance method. Okay, so what it is the straight line rate. Now, the straight line rate is okay, so the straight line rate is 100% divided by the years of the units of the years of production. Years of, divided by the use. Let's call it the useful life. I think would be the clearest way of putting it. Divided by the years of useful life. So in this case, it'll be 100% divided by 5. So in this example, we're going to keep it for 5 years. So that's 20% per year. And then you double that to 40%. And that's where they get the double declining. Okay? So, the straight line rate is 100% divided by the years of useful life. So 100% divided by 5 is 20% per year. Does that make sense? And because it's double it, it's twice 20% or 40%. Okay, I'll make that more of a legitimate percent sign. Now, the other two, what the other two methods did is they calculated the depreciable cost and then they divvied it up. They divvied up the depreciable cost, right? So when you had the straight line, you found the depreciable cost and divvied it up the same amount each year. Okay? Units of production, just as before, you figured the depreciable cost and divvied that up per usage, right? This one's different. What it is the book value times the double declining rate. So it's the book value times the double declining rate. So, in this particular example, the first year, they paid $10,000 for this thing, and that's the book value when you buy it. 40% is double the declining, so that means the first year there's $4,000 worth of depreciation. And of course, cars do work this way. So for instance, what can happen on this thing is you can buy a brand new car. It's happened. People bought a brand new car, drove it off the lot, but in one block, cracked it up. And the insurance company paid them replacement value for a used car, which is a few $1,000s less. And we're talking about a block. Okay? And again, the only reason I tell a little story like that is I hope it makes it memorable. Okay? But that's an example of accelerated depreciation, right? Where most of the largest depreciation occurs in the first year. Like, I was surprised. Lincolns lose half their value in the first 2 years, on average, according to Consumer Reports. Which surprised me, because they're not cheap. They're pretty nice cars. Yeah.
So, I'm kind of confused. So like what happens so let's say, so the first year you lose 40%, and the second year you lose another 40%?
Well, now in the next year, the book value will now be $6,000. So we multiply that times 40%.
Oh.
And then you stop at the salvage value. I think is where you're heading with this. Is that right?
You know, yeah, I should have thought about it that the book value is now 6,000, but I was taking it from 10. I was like, okay, so now you're at 8,000, so it's only worth $2,000, and then what do you do the third year? Because it's only worth 2,000, but that way makes a lot
That's
of
it.
sense.
So the first year, the book value is 10,000. That's what it is when you pay for it. Then 4,000 loss. So now the book value is down to 6. You take 40% of that.
Yeah.
And then, you keep going, the book value keeps getting smaller each year rapidly.
Yeah,
And then you stop
at the salvage
at the
value.
salvage value. All right, does that make sense? All right, so let's do this. Let's take a look at some videos here, or some slides, and then we'll do some practice. So I'm going to turn this around. Okay. All right, now, in terms of I just can't believe it. The PowerPoint, the overhead camera, that camera, my iPod. Yeah, talk about a sophisticated guy. Oh, darn. All right, okay. All right, so here's double declining balance. So again, step one, the straight line rate. The straight line rate is 100% divided by useful life. So 100%, 5 years is how long you expect to keep, 20% per year. And then the double declining rate is twice that, or 40%. And then the depreciation expense is the double declining rate, which is 40%, times the book value at the beginning of the period. Okay, does that make sense? Now, if we look at this over time, so it would start out at 10,000, 40% of that is 4,000, that's the depreciation expense for year one, that's the accumulated depreciation after year one, and the book value at the end of year one is 6,000, right? So it's 6,000 at the end of year one becomes 6,000 at the beginning of year two, which is 2012. Multiply that times 40%, 2,400 is the expense for that year. Now 24 plus 4, now the accumulated depreciation is up to 6,400. And subtract that from 10,000, now the book value is down to 3,600. That becomes the book value for the beginning of the following year at midnight. The ending becomes the beginning, multiply it times 40%, and so forth. And then, on the last year, 40% of this is an amount that's bigger. So what you do is you take an amount that brings it down to $1,000. So the difference between this and 1,000 is $296. Does that make sense? And you just stop, was that?
I'm sorry to interrupt, because it came below book value.
No, you just assume, at this point in time, it was a good estimate. Now, we'll show you what happens when you revise your estimates. But unless you revised your estimates, this is how you do it. Now, you can say, part of the way through, you can say, listen, this thing's going to last not 5 years, but 10 years. And you revise it on that basis, but that's not what we're talking about here. With no revisions, this is where you stop. Okay, there's no revisions at this point. And what they're saying is there'd be no point in declaring more depreciation expense than you actually incur. That doesn't make any sense. And again, it's going to be off, but then when you sell it is when you reconcile it. In this case, if they sold it at the end of 2015, if they sold it for an amount greater than 1,000 gain in disposal, and amount less than 1,000 loss in disposal. And that's where it's reconciled, where the estimates, and the estimates, they can be close, but they're always going to be off. And that's where it's going to be reconciled.
In this chapter, will we have to reconcile or no?
Yeah.
We will do
Yeah. Yeah, you can sell it, you can dispose of it, you can sell it, you can trade it in. But how much is it actually worth compared to what you estimated? All right, you guys are okay with that. Let's do this. Let's do quick study 10-6. Okay. So let's do quick study 10-6. And you find that on page 421. So here's how it reads. So here's 10-6. All right? So on 10-6, what it says is, I'll turn out that light so that's more readable. So what it says is, a fleet of refrigerated trucks is acquired on January 5th, 2011 at a cost of $930,000 with an estimated useful life of 8 years and an estimated salvage value of $150,000. Compute the depreciation expense for the first 3 years using the